Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome to the Investing Podcast. I'm Andrew Hall. Ben Nye, how are you, sir?
I'm doing well.
Good. Today we are talking about Unilever's earnings. Pretty interesting quarter for them. Some price increases, a lot of kind of themes that I think there's some macro read-throughs on. But jumping out, right off the bat, what really stood out to you, Ben?
Yeah, I think there were three things that really stood out to me. The first was they're executing on the stuff that they said in the investor day. So they're in line with that. I mean, they did just come out with that 2 weeks ago, so they should be.
Surprise!
But so that's good news. I think the strategic review is really, if you look at a stock chart, the price is up about 10% pretty quickly. Part of that was due to the Kraft Heinz takeover offer, and then part of that was due to the strategic review. Second thing was pricing, as you mentioned. That has really improved pretty nicely. They're starting to see more commodity price inflation, which is good for them. And then lastly is emerging markets, which stabilized a bit. Brazil is still fairly bad, but the rest of Latin America is strong, Mexico, Argentina. And then Europe is stabilizing. For once, we don't have these massive geopolitical headwinds in terms of economic growth. Yes, there's a lot of noise in the Middle East and in Korea, but in terms of is Europe totally falling apart? For once, we're not having that, which is a bit different from recent history. So overall, decent quarter, but not a whole lot to go off of. It's a long cycle business.
Definitely a long cycle business. I thought the thing, I want to camp out a little bit on pricing. We've talked a lot, in our in-a-day podcast and things like that about just kind of the economy as a whole, where we stand. Certainly seems like a positive read-through on a broader sense to see a company like this actually start to see pricing go up like 3%. Estimate was 2.6, which is a strong number. I guess you could loosely compare that to what you see on GDP type numbers, and that certainly surpasses that. So to see that come in at 3% seems like a solid read-through there, and it also seems like one that's fairly sustainable, just based on what we're starting to see on kind of the pricing power and things like that.
Yeah, it seems like people are starting to move away from the idea of, well, I'm going to go to the store, I'm going to buy the cheapest soap.
Right.
I'm going to buy the cheapest ice cream. And now it's gotten to a point where I'm going to go to the store, I'm going to look at price, and I'm going to be respectful of that. I'm not going to pay double for something. But I am going to, if something appears to be of higher quality, I may opt for that, which means innovation is getting rewarded. So some of these higher value-add brand names, they just released Baby Dove, and that's having a good uptake.
They released Baby Doves? Got him. You walked right into that.
I did. So things like that are starting to help on the pricing side. People just becoming less price sensitive to things, and maybe some of the minimum wage increases, maybe some of the just wage inflation that we've seen in general is starting to trickle through and affect and allow people to be more flexible to that pricing.
And I think you kind of see a similar story on the other topic that you hit on just a few minutes ago in terms of the emerging markets. Kind of this, almost a global story in terms of this company, but also maybe something we can be kind of keeping an eye out on.
Yeah, China's an important market for them in that regard. India, they're not allowed to give many specifics on India because of they have another separately traded stock there that hasn't reported yet, but the indication was that India's doing pretty well. And then, like I said, in Latin America, improving as well. Brazil still down 5 to 6% in the second half of the quarter. First half of the quarter was down 10% though. So things going in a better direction there. Still need to get the volume piece side of the equation up. North America, there's a bit of a headwind there. But you also had one fewer day because last year was a leap year. And then there was a later Easter, so a lot of your confectionery sales are going to be pushed forward into the second quarter.
Other thing, I mean, just broadly speaking, I mean, when you look at this company, it's not one that, I guess I would historically say, oh, this is a growth company. But interesting to see, just underlying sales growth target of 3 to 5%. I mean, 5% growth for a company like this is pretty phenomenal, I would say, for the full year. And that's kind of what they still say they're shooting for. Obviously, 3% is not quite as phenomenal as 5%, but at the same time, kind of an aggressive trajectory, I would say, in some regards.
And you couple with that with their strategy of improving operating margins, and you think, well, if they are able to really come up with that top line growth, all of a sudden that operating margin improvement of going from 17, 18 to 20% operating margins in 2020, that doesn't seem as unrealistic, and they're trying to target 80 basis points a year. And it looks like they have a really good shot at that if they can continue to execute on the top line, and especially on pricing, because that just flows through to the bottom line.
You mentioned, this is kind of a long cycle turnaround. It's going to take some time. Lots of positive signs, though. I would say, we don't want to get the cart ahead of the horses. Is that I don't know if that's right or not. We don't want to do that though. But at the same time, I mean, definitely seems like a company to have some optimism on. We're holders here at Narwhal Capital, with a long-term perspective. With most stocks we own, it's somewhat long-term, I guess. So it's not totally unique in that regard. But it seems like this is going to be a story, kind of quarter by quarter, seeing where we go, looking at that efficiency, looking at that top end, but a company with a lot of prospects.
Yeah, and I think what really catalyzed that change, because for a while, they were just happy to operate as they operated. But when Kraft Heinz came in and said, we would buy this company, and it was rejected out of hand by Unilever management very quickly, but I think it did have the effect of saying, wait, we are operating at a much lower ability than the rest of our competition on margin. Our margins are substantially lower. We have an opportunity to increase shareholder returns, improve the cash flow conversion. So I think that did have an impact. And so that encourages me on management. I don't think they're just as comfortable to be happy with things as they are. I think they actually are looking for improvements now, which is an important change. And I think that the things that they're doing, they're selling off the spreads business. I think things like that are indications that they really want to get better, and now it's just kind of a wait and see approach. And we'll get these intermediate updates every quarter, but as they keep going back to, Q4 was a pretty bad quarter for Unilever. Q1 was a pretty good quarter. Just takes time. I mean, look at the evidence based on years, not so much as quarters, and especially look for that operating margin gap versus its competitors, which average like 21% margin. Look for that gap to close.
Very good, very good. Some good things to keep an eye on. Ben, any other closing thoughts on Unilever in their quarter?
No, I mean, they do seem like a bit of an expensive stock right here, but I think they're on the right side of guidance, and I think they have the potential to continue to improve fundamentally, and I think those fundamentals have a good chance of catching up to the stock.
Very good. This is the Investing Podcast. Thanks for being here.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.